You have a whole life insurance policy and it has some cash value accumulated in it. Furthermore, you'd like to take some of that cash value out of the whole life policy. But should you take a loan against the policy or should you just withdraw some of the cash in the policy? Stick around and I'll give you the answer. Generally speaking, there are three reasons you would take cash out of a whole life insurance policy. They include lump sum cash needs, covering the premium that's due, and creating a retirement income stream. The truth is, you can use loans or withdrawals in any of those situations, but there certainly is a better time to use one versus the other. If you're taking a lump sum distribution from a whole life policy, this could be for any reason you want it to be. Something like you need to buy a car, or there's been an emergency expense that's come up. You want to go on vacation. It doesn't matter for whole life insurance. You can take whatever money you want out of it whenever you want to. There's no restriction on that. And in those situations, you could take a loan, you could take a withdrawal. But I would tell you the guiding force behind that decision really depends on if you intend to put money back into the policy. So if you're taking a distribution from the whole life policy and you have zero intentions of ever attempting to put the money back in there, take a withdrawal. It'll make life so much simpler. But if, on the other hand, you are planning to put money back into this whole life policy that you took out for whatever this lump sum need was, then a loan makes a lot of sense. And here's why that is. Functionally speaking, whole life insurance doesn't have any mechanism that will allow you to put back withdrawals. The way you put additional money into a whole life policy is through the paid up additions rider. And if your policy is designed correctly, you won't have any capacity to go back and put money that you took out in any given year because you'll be maximizing it with the annual premium that you contribute to the whole life policy. Now, there are some circumstances where this won't necessarily be true because the policy might be intentionally designed to accept additional premium, but be very careful about those situations because generally speaking, if you are looking at a policy where that is the recommendation, there's a really good chance you will not optimize the cash value growth in the policy because you won't truly take advantage of the funding capacity of the policy. I don't like those approaches, so I don't generally recommend them. So this means if you take a withdrawal of cash from a whole life policy, you will lack the ability to put money back in. On the other hand, if you've taken a loan against the policy, repaying the loan is effectively putting the money back into it. Additionally, you should know that when you take a loan against a whole life policy, the cash value that gave you capacity to the loan doesn't leave the policy. It acts as collateral for the loan, which is issued to you by the insurance company. This means that the value that remains inside your whole life policy will continue to earn guaranteed interest payable by contract, as well as dividends to some degree. So while you have effectively removed that cash in the policy to do something else with it, you are going to continue to benefit from its existence when it comes to the accumulation of values of your whole life policy. Now, there are going to be times throughout the lifetime of a certain number of whole life policy owners where they simply don't have the money to cover the premium that's due on the policy exactly when it's due. This might be because of some sort of emergency expense that's come up, a job loss, or it could look something like, I have an opportunity and I need all the money to go towards that right now, and I really don't want to pay the premium. And the good news is, when you have accumulated cash value in a whole life policy, you can use some of that cash value to cover the premium when it's due so you don't have to come up with the money from outside sources. And again, withdrawing money to cover this premium and or taking a loan to cover the premium when it's due are both viable options. In fact, most whole life policies are set up at inception to automatically create a loan if you fail to pay the premium on time. So if you receive the premium due notice from the insurance company and you don't pay it by the due date and the grace period has elapsed, the insurance company will, in those cases, automatically create a loan and pay the premium that's due so you don't lose your coverage. And that, of course, is one time when a loan is definitely going to be used. But if you're going to practice a little more discretion over how you go about paying the premium with cash value inside your whole life policy, the general rule will be very similar to the last discussion we just had about lump sums. If you have no intentions of going back and making that missed premium payment up, take a withdrawal, life is simpler. If, on the other hand, you do intend to make that premium payment, just not right now, a loan makes perfect sense because you will have the ability to go and effectively make that loan payment, or excuse me, that premium payment when you pay back the loan balance. This could be immediately as a lump sum, or it could be over the course of many months or years, however it is you need to approach it. And by now, you're probably seeing a little bit of a trend when it comes to when a loan versus when a withdrawal makes the most sense. But now we're going to talk about income, and it's a bit more nuanced. The cash value in whole life insurance is absolutely an asset, and it can certainly provide you with retirement income if you choose to use it that way. There's a multitude of reasons why you might look at whole life insurance for this purpose. That's a discussion for another day. But for now, let's just talk about how you would approach this from a withdrawal versus taking a loan perspective. For the most part, you will start income distribution from a whole life policy as withdrawals. And you will do this to recover your non-taxable basis in the whole life insurance policy. Every time you pay a premium to the whole life policy, that premium is counted as contributions you made. It's part of your basis in that policy. So the cash value that exists in excess of the premiums that you paid, that's gain. But all of the dollars that you yourself put in, that is your cost basis in the whole life contract. And whole life insurance, as well as other types of cash value life insurance, benefit from a phenomenal aspect in the tax code that allows you to withdraw your basis first before you have to take out any of the gain in the contract. The accounting principle that this follows is called first in, first out. You may also hear it referred to simply as FIFO. And while life insurance is not the only asset that has a FIFO capability, it is one of very, very few assets that has a FIFO capability, another major one being Roth IRAs. So you can begin your income distribution as a withdrawal of your cost basis year over year. And you do this because that does not carry an income tax liability to you. Since it is your cost basis, if you take it out, you do not owe any sort of income tax on that. But once you've exhausted the cost basis in a whole life insurance policy, now in order to keep your income stream tax-free, you need to take loans, because if you don't, you will incur ordinary income taxes on those distributions. And so long as the policy remains in force for the remainder of your life, all of those distributions taken as loans will not incur an income tax liability to you. Now, technically speaking, you could take loans from the outset and be mostly fine. Probably isn't going to optimize the most amount of cash you could extract in an income scenario from a whole life insurance policy. But if you wanted to, you absolutely could just take loans. They would be income tax free, again, provided the policy remains in force for the remainder of your lifetime. And it's not really going to cause any major problem. And in fact, you should be a little bit careful about any sort of projection that shows you taking income from a whole life policy where only loans are used. And you should dig a little deeper into what the assumptions are about loan rates versus dividend interest rates or dividend scales. Because there are times when the current company dividend scale has a reasonable margin above whatever the current loan rate is on the contract. And some insurance companies will take advantage of this spread to show a perhaps overly optimistic income stream coming out of the whole life policy. In truth, if there is much of a gap between loan interest rate and dividend scale, it's unlikely to remain that way for any number of years. So just taking loans in this situation may look really good on paper when we assume that spread. It probably won't play out that way. Now, on top of all of this, there are a few rules you should be aware of regarding loans and withdrawals and when they're available. There are some, not every, but some insurance companies that have rules about when loans become available after a policy has been put in force. In general, if there is any kind of limited access to loan activity, it's the first, maybe second year of the policy's existence. So what that means is, even if the policy has cash value accumulated in it, you do not have access to a loan. You can withdraw non-guaranteed cash from it, but you can't take a loan against it. In addition to that, understand that any of the base guaranteed cash value that has accumulated in a whole life insurance policy can only be accessed via a policy loan. You cannot withdraw any of that cash. And if you need further explanation on that, we do have a video we've done, and we'll put it in the notes of this video for you to go check out. Now, one other point on the lump sum distribution side, especially given this discussion about cost basis coming out through a FIFO distribution and a withdrawal versus loans, you could theoretically end up in a situation where you've had a policy for a while and you've taken several distributions from it. These don't necessarily have to be income distributions. They're just lump sum distributions you've taken over the years, and you had no intention of paying any of them back, so you always took them as withdrawals. It is conceivably possible that you may end up in a situation where you have now taken all of your cost basis out of the whole life policy. And if that circumstance has transpired, then you would probably at that point take loans only for future lump sum distributions from the whole life policy in order to keep those distributions tax-free. It's also important to understand that there are some consequences regarding the death benefit when it comes to taking a withdrawal versus a loan against a whole life insurance policy. So the cash value that you have withdrawal access to, this is the non-guaranteed cash value, or the cash value that's created by paid-up additions. This cash value also created a certain level of additional non-guaranteed death benefit that is a part of your whole life policy. Functionally speaking, when you put $1 into paid-up additions, whether you did it through the paid-up additions dividend option or you yourself have a rider that allows you to electively make excess payments to your whole life policy via the paid-up additions rider, every time you do that, you are getting death benefit that is created guaranteed by the payment to the paid-up additions feature. This might look something like $1 used to purchase a paid-up addition creates $3 of outstanding death benefit. The exact amount changes over time. You get more death benefit when you're younger, less death benefit when you're older. But since you have to surrender those paid-up additions when you withdraw cash from a whole life insurance policy, it also means you have to forfeit the death benefit that was created when you purchased that paid up addition. So when you take a withdrawal from a whole life policy, you are going to see a reduction in outstanding death benefit that is larger than the cash you withdrew. Using my 3-to-1 example from earlier, this might look something like you take a $10,000 withdrawal from a whole life policy, and the net effect of that is a $30,000 reduction of the outstanding death benefit that was on the policy. Now, to be clear, I'm not talking about the original guaranteed death benefit here. I'm only talking about the death benefit that was accumulated through paid-up additions. That is what gets impacted. Your original guaranteed death benefit will never be affected by any of this. Alternatively, when you take a loan against a whole life insurance policy's cash value, you will reduce the death benefit dollar for dollar, because if you die with the loan outstanding, the insurance company will take part of the death benefit to retire the loan. But there will not be a multiple of death benefit that is reduced when you take a loan against your whole life insurance policy. So in this example, if you take a $10,000 loan against your whole life policy, your death benefit, net death benefit, will be reduced by $10,000. And to give you some sense of how this would actually play out in real life, we have a whole life insurance ledger in front of us to evaluate the impact withdrawals versus loans have on the death benefit outstanding on a whole life insurance policy. So this one in particular has a $1 million initial death benefit. That's the guaranteed death benefit, provided that the base whole life contract premium is paid. That's $21,360. I want to go down to age 71 and look at the outstanding death benefit on the policy. It's $1,689,069. So it's grown by almost $700,000 over the initial death benefit over a 26-year period. Now, let's take a withdrawal and a loan against this policy to see what the impact on death benefit is, comparing the two against each other, both in the year that we take the distribution and also what happens longer term on the policy. So here's the withdrawal example. So same $1 million death benefit, same premium going into the policy, same time frame, only at age 71, we've taken $100,000 out of the policy as a withdrawal. We've withdrawn some of the cash value in the policy, or we've surrendered some of the paid up additions that had existed on the policy. Notice the change in death benefit now. $1,516,145 is what we end up with for a net death benefit because of this $100,000 withdrawal of cash from the life insurance policy. we've definitely lost more than $100,000 of death benefit versus what we would have had we not touched any of the money in the contract. Now, if we look at the loan example, we'll see the death benefit reduction is just about $100,000. There's some vagary in terms of the assumptions that are going on here that cause it to be ever so slightly higher than a $100,000 reduction versus what would have been there, but not near as much a reduction as we saw when we took the withdrawal against the policy. But notice something else. I'm going to look at age 75. The death benefit outstanding at that point, $1,775,000.92. If we go back to the withdrawal example and we look at age 75, the death benefit's $1,714,220. So it's still behind what's going on when we took the loan. And remember, that's happening despite the fact that there is loan interest that is accumulating as part of the loan. So the loan balance is actually growing year over year over year. We can see that representative right here, total outstanding loan. So we've gone from a $100,000 loan to a $123,000 loan, but we still have more death benefit on the policy versus the withdrawal, where all we did was take out $100,000 and incurred no interest accumulation on that. The reason that you're seeing the death benefit remain higher in the example where we take the loan versus the withdrawal, even though the loan is accumulating interest, which is adding to the loan balance, is twofold. One, there's the fact that we didn't lose all the death benefit that we did in the withdrawal scenario. But on top of that, remember something that I said earlier. The value, the cash value that's in the policy that makes the loan available in the first place doesn't actually leave, doesn't go anywhere. It just gets pledged as collateral for the loan that we took from the insurance company to access our $100,000. This means that the value that $100,000 represents is not lost from the policy, and it continues to deliver value to the policy. So it will continue to compound cash value and death benefit, even though the loan balance itself is growing, and it happens to do it in a way that outpaces the growth of the loan. This isn't all that shocking since the amount of cash value and death benefit outstanding is significantly larger than the loan itself was taken at age 71. Now, I do want to be careful, and I want to make sure that you don't hear what I'm not saying. This by no means is to suggest that in all situations where you want to preserve death benefits, you absolutely should take a loan. It'll be true in most cases, but you should certainly take a little bit of time to carefully look at your particular policy and make sure that that is the way things will function. The big takeaway that I do want you to catch here is the fact that generally speaking, if you're trying to preserve the death benefit outstanding on your policy, a loan will most of the time be the way you do that. And as always, if you're looking for assistance with your current policy or a brand new policy you're looking to start, you can always reach out to us at theinsuranceproblog.com.